Hey everybody, my name is Nate. This is the DivMan channel, and today I want to ask the question, given the fact that certain high yield ETFs like, I don't know, say MSTY, which is a fund I cover a lot because there's a lot of interest on YouTube for it. This is the year-to-date chart for MSTY. So you can see it's down 24.13% year-to-date. Now that's not the full story if you stayed invested that whole time, because the fund actually paid, you see it's down per share about $6.55. The fund actually paid about $5.67 per share already year to date. So you're down a lot less than 24.13% in terms of total return. Nevertheless, you are down a little bit year to date, and the NAV definitely is down a little bit year to date. So, is there a way aside from having DRIP, that's Dividend Reinvestment Program, DRIP, is there a way other than having DRIP turned on to keep your funds fully invested in MSTY? Or any high yield fund? Is there another strategy? Is there a way to, as the fund, is kind of, it's following the underlying has been chopping like this since January. Is there a way to better keep your capital? And so I was asking, ChatGPT, what are some ways to get around this? Now, in a bull market, it turns out that turning on dividend reinvestment is the best way to keep your funds invested. And the reason that turning on the dividend reinvestment is the best option is because you're grabbing the share price immediately as the dividend pays, so you're locking in your price and you're getting that compounding effect. Now, if it's a bear market, meaning the fund is losing a little bit of capital, at least in the short term, turning on DRIP actually turns out to be a little bit of a bad thing because you're compounding downward. And so, as the fund goes down, you're fully invested in that instance and you're losing a little bit of your capital. Now, the alternative is daily dividend reinvestment. So this turns out to be not as good an investment strategy during a bull market, and it actually turns out to be pretty decent on choppy markets, so up and down, kind of sideways. But on a bear market status, where the market keeps just kind of dumping, it ends up being the winner as far as total returns, according to ChatGPT and Grok. I asked both those things. So basically what you would do is, instead of having automatic dividend reinvestment, what you can do is figure out what the average dividend is for the fund, and then maybe go just a little bit under that. So it's, depending on how much you've got invested, you'll just put the total amount of the monthly dividend, and then you'll just turn on a recurring investment. So here's how I would do it in Robinhood. I would just do like $2 a day. I would do every market day, and then I would do it from buying power. You can also set up backup payments from like your checking account or something like that. And then you would click, start. And so that's going to put in $2 a day into a particular fund in order to, as stuff like this happens, you end up never buying you end up buying the top and the bottom, because you're gonna buy each market day $1, $1, $1, $1, $1, $1, or whatever the amount is. And so that way you're not buying right here, for instance, and then boom, losing a lot of capital because you're fully invested at that point. So this way, whatever your dividend is that month, you can kind of grab some along the way down, so that if, let's see here, here's February 27th, it was $19.11 per share. You see, you get to ride some of the momentum up because you're buying the bottom. You're buying every day, so you get to buy the bottom, not just the top. And when you buy the top, you're not buying in lump sum, you're buying little bits at a time. So you might end up with, a winning strategy by simply buying a little bit at a time instead of using dividend reinvestment as like a lump sum purchase every time you get a dividend. So I just wanted to talk about that as an alternative, given the fact that the markets are really darn choppy, if not just, kind of dumping all the time. So that can kind of be an alternative to keep your capital, to, to take it a little bit at a time and beat this bear market, or at least this choppy market. Hope this was helpful. Thanks for your time. Please like and subscribe. Bye.